Okay, so one of the first things I want to talk about is what causes a balance due. So a balance due is a tax liability that is owed to the government. So there are four basic ways that balance dues occur. The first is you file a tax return showing a liability that's owed to the government that is not paid. So if a taxpayer files a return, they owe $10,000, they don't include a check with that, that will create a balance due within the IRS's system. The second way that balance dues are formed is through the matching program that the IRS has. When the taxpayer files a tax return not showing a tax liability, but there are either errors or omissions on that tax return, then the IRS will make a correction. Oftentimes they issue the correction through what's called a CP 2000 notice. The taxpayer will file a return. They'll get a nice letter in the mail saying, hey, we noticed you left off some income, you didn't report a 1099 that you had, you stated a credit that we don't believe you're entitled to. Any number of things can cause a CP 2000. If the taxpayer doesn't respond or challenge that CP 2000, then the IRS will make the adjustment and the balance due will become final. The third way to have a balance due is through an audit. So the taxpayer submits a return, the IRS takes a look at it, and then decides they want to audit the return. I will go a little bit into audits, although it's outside the scope of this presentation, but audits can happen in three ways. It can happen through correspondence, which is through the mail. It can happen at the IRS's office where the taxpayer is called in. Or the third and most serious type of audit is what we call field audit. It's where the IRS will go out into a taxpayer's business or their home, or preferably in their attorney's office, and conduct the audit that way.